Capital Asset Pricing Model Purpose and Role of CAPM. The Capital Asset Pricing Model CAPM, is a financial model used to estimate the required return on an investment based on its level of systematic risk. It is widely used to calculate the cost of equity capital for a company, which is then applied in investment appraisal and business valuation. The model assumes that investors are risk-averse and require compensation for taking on additional risk compared with a risk-free investment. CAPM provides a systematic way to estimate this required return by combining the risk-free rate, the expected market risk premium, and the investment sensitivity to market movements. The resulting cost of equity represents the minimum return required by shareholders. Systematic and unsystematic risk in CAPM. CAPM distinguishes between two types of risk affecting investments. Unsystematic risk is company-specific risk arising from internal factors such as operational failures, management decisions, or product development outcomes. This type of risk can be diversified away by holding a portfolio of different investments. Systematic risk, on the other hand, arises from broader economic factors such as interest rates, inflation, or changes in economic growth. Systematic risk cannot be eliminated through diversification, and therefore influences the return required by investors. CAPM focuses exclusively on systematic risk because well-diversified investors are assumed to eliminate company-specific risk through diversification. Beta and calculation of cost of equity. In CAPM, systematic risk is measured by the beta symbol, coefficient, which indicates how sensitive a company's returns are to movements in the overall market. A beta of 1 means the investment has the same level of risk as the market portfolio, while a beta greater than 1 indicates higher volatility and risk. The CAPM formula estimates the cost of equity as the risk-free rate plus the market risk premium multiplied by the investment's beta. This calculation allows analysts to determine an appropriate discount rate for valuing future cash flows and assessing investment opportunities based on their risk characteristics.